Every investment is made twice. First with the decision, then with your money. Look, you've worked hard for your money. So how do you make sure that your first investment isn't your biggest mistake? We often think that great real estate investments are decided at the auction. They aren't. They're decided before you ever place your first bid. Today, I'm going to show you the 4 questions every investor should answer before investing in a tax lien or tax deed property.
We're going to answer these 4 questions with the 4P framework, our 4 Ps of tax liens and deeds. The 4P framework includes profile, property, person, and place. Briefly here, but remember, as tax lien investors, we're focused on a mandated interest rate return on our money. As tax deed investors, we're focused on property acquisition. And of course, don't forget, note takers are moneymakers. The wealthiest people ask questions and take notes. So you may want to make sure you're jotting down anything relevant to you or any questions you might have. So let's get into the 4P framework, our 4 Ps. Again, profile, property, person, and place. Our first P, profile. The question to ask here is, what is my investment strategy? Now, you may say, CJ, how do I know my investment strategy? Well, it's very simple. You have to ask yourself one question. What are my goals? Understand that everything starts here. Now, how do you establish your goals? Well, you've got to write the vision and you got to make it plain. All right, what do you want? Or how about we just get into it and start building your profile? Okay, so ask yourself these questions. Do I want to invest in tax liens and get a mandated interest rate on my return on my money? Or do I want to invest in tax deeds and focus on property acquisition? And if I want property, what kind? Do I want land and acreage? Do I want homes? Maybe multi-unit apartments or even commercial? And when I do acquire these properties, what is my goal? Do I want cash flow, which is going to build my capital? Or do I want cash grow, which is going to appreciate and build that long-term wealth? I don't know, but you do. Look, only you can make the decision on your goals. You know yourself best. So write the vision, make it plain, and once you know your goals, you'll know your investment strategy. And that's going to create your profile, your investor profile. So that's our first P, profile. Next up, property. The question we ask ourselves here is, will this move me toward achieving my goal? A simple test for that is this property valuable? Well, valuable to who? A property can only be valuable to 2 parties, either to you or to the market. If it's valuable to you, it's because you want to move into it or hold it long term to build wealth and pass down through generations. If it's valuable to the market, it has to be rentable or sellable. So here's the test for both land and homes to determine if they're valuable. To determine if land is valuable, there are 3 things to confirm. Is it buildable? Is it accessible? Is it usable? And for homes, is it rentable? Is it fix and flippable? Or is it move-inable? The property should support the goals that you've already established in your profile. Because what are you going to do with a drainage ditch or a burned down house? Well, one man's trash can be another man's treasure. We'll cover that here in a minute. That's our second P, property. Our third P, person. The biggest question to ask here is, who owns or owned this property? The simple thought we want going into our research on the person is there a story here? And if so, what is it? Was this owned by a business or a person? Do they even live in this country? I mean, are they even alive? Understand that we just want to know the story here and check into anything else we should know about the property before investing. Because sometimes the owner tells you more about the investment than the property itself. And that's our third P, person. And now our last P, place. Always ask, where is this area headed? Is there development in the area, or is the area deteriorating? A simple thought we want to know, is there gain in growth or depreciation and decline? Now, what do I mean by area? I mean the surrounding neighborhoods and community, the development in the neighborhoods, the direction of the community, the opportunities coming to the county. I'll give you a brief example of a personal investment in Charlotte County, Florida. I didn't invest because the land was special or because it had a special place in my heart. I invested because the community was growing. I knew that land would become more valuable. There were a few multi-million-dollar projects upcoming over the next few years that included development of office buildings, apartment buildings, restaurants, entertainment. There's a manufacturing plant coming that'll bring jobs, and they build the Buc-ee's. Now that's opportunity. I fell in love with the future appreciation of that community, and I knew my investment would grow exponentially over the next few years because the opportunity, the growth, and the development of that community. Now, maybe you don't want to invest in Florida, and that's okay. You can invest anywhere you want. You don't even have to live there. Remember, there are over 3,000 counties to invest in. The entire United States is our backyard. So you don't have to live where you're investing, but you should believe in where you're investing. And if you do want to invest where you live, ask yourself, what are some up and coming areas in my state that may provide me with the opportunity to help the community and possibly grow my investment in the process? Just something to think about, for the opportunities across the 3,000 counties here in the US. Here's the thing. I'm sure you've caught on by now. There are no universal good investments, only investments that fit your strategy. That's why what looks bad to one investor may be a great opportunity for another investor, because one man's trash can be another man's treasure. Let's say we have investor Joey and investor Janelle, and they're going to the state of Texas, a redeemable deed state, and they're in Houston, Texas, Harris County. And some vacant land has some weird zoning going on. So investor Joey says, I don't even understand what's happening here. I don't have any zoning experience. You know what? I'm out. While investor Janelle says, well, I know about rezoning. I've done that before. So she decides to focus on that property and pursues it at the auction. Now, let's head up to Oklahoma, and we're in Tulsa County. There's a burned down house. Now, Oklahoma's a tax deed state, so we're focused on property acquisition. And investor Joey says, I've done fix and flips. This is my bread and butter. I'm going to get this property. So that becomes the focus and one of the properties to pursue. While investor Janelle says, I don't know fix and flips. This property, there's opportunity here, but it's too risky for me. This is outside of my profile. I'm going to pass. Now, there are some deals that are almost always trash, like swampland or small unusable lots, drainage ditches, even landlocked property that we cannot access. These are usually going to be worthless for everyone. So a great real estate investment depends more on the investor than the property itself. And this is so important because, y'all, our money is made and our money is lost in our due diligence. A belief that's always guided me on my tax lien investing journey is my dollars are in my due diligence. And if you also adapt that philosophy, you'll quickly begin to realize due diligence isn't meant to scare us. It's meant to protect us, because there are no good universal investment strategies, only investments that fit your strategy. They either fit or they don't fit into your unique investment strategy. Due diligence isn't about avoiding deals. It's about recognizing the right deal for you. Our 4 Ps. Profile. What are my goals? Property. Will this move me toward my goal? Person. Is there a story here? If so, what is it? And lastly, place. Where is the area headed?